Bismillahirrahmanirrahim. Assalamualaikum warahmatullahi wabarakatuh dan selamat pagi dan salam sejahtera tuan-tuan dan puan-puan sekalian. Pada sidang akhbar pada hari ini, Bank Negara Malaysia dan Jabatan Perangkaan Malaysia akan menyampaikan taklimat mengenai prestasi pertumbuhan ekonomi negara pada suku tahun kedua tahun 2017. Seperti biasa, taklimat ini juga merangkumi perkembangan monetary dan kewangan di Malaysia serta butiran mengenai inisiatif dasar Bank Negara Malaysia. Ekonomi negara mencatatkan pertumbuhan yang memberangsangkan sebanyak 5.8% pada suku kedua dan terus disokong oleh permintaan dalam negeri. Let me begin with some positive development in the global economy. In sharp contrast to the performance in 2016, second quarter data showed that the global economy continued to expand strongly. The global economic recovery has become more entrenched. In the advanced economies, the broad-based increase in investment amid the steady growth in consumption supported the higher growth. In Asia, better than expected external demand complemented the continued expansion in domestic activity. A significant development is the stronger global trade data, which have accompanied the improvement in global growth. The robust global trade was underpinned by the rise in investment in the advanced economies and sustained strength in the domestic demand in China. In Asia, particularly, export growth continued to record robust double-digit expansion in the second quarter 2017. Importantly, the outlook for global trade has also improved compared to the beginning of the year. Malaysia has benefited from this positive global development. Real export of goods and services continued to register strong growth. The favorable external performance has generated positive spillover to the domestic economy. In particular, private consumption was lifted by the higher private sector wages in both the export and domestic-oriented industries. Employment has risen, sentiment and confidence has improved. Private investment was supported by high orders and capacity utilization rate. Import moderated slightly following the lower investment growth. Hence, on a net basis, the external sector provided support to overall GDP growth. On the supply side, all economic sectors recorded expansion. The services sector registered higher growth, benefiting from improvement in household spending, capital market amid strong trade-related activities. Growth in the manufacturing sector was driven by the export and domestic-oriented industries on higher global semiconductor demand and continued growth in domestic demand, respectively. In the construction sector, the higher growth was supported by civil engineering subsector. Growth remained firm in the agriculture sector as crude palm oil yield continued to improve. During the quarter, private consumption growth rose significantly to 7.1%. In the first quarter of 2017, if you can recall, the same number was 6.6%, supported by improvement in labour market condition. Employment growth in the first half of 2017 was 2 times higher than in 2016, as firms increased hiring amid strong economic expansion and greater optimism. Private sector wage growth also trended upwards. Reflecting the positive employment and income prospect, consumer sentiment also improved further. The MIER Consumer Sentiment Index improved to 80.7 point. The number for first quarter of 2017 was 76.6 point, while the Mastercard Index of Consumer Sentiment increased to 42.3 points. The same number was 31.2 points in the second half of 2016. This provided impetus to household spending. However, consumer confidence remained below the optimism threshold. At this point, households remain cautious in their spending on big-ticket items on expectation for higher cost of living. Let me look at the private investment. Private investment recorded a growth of 7.4%, benefiting from the favorable external conditions. Of significant improving business sentiment, firms had expanded their capacity, acquire and replace their machinery and equipment, particularly in the services and manufacturing sectors. Let's look at the inflation numbers. Headline inflation moderated to 4% in the second quarter of 2017. The first quarter numbers was 4.3%. It declined from its peak in March of 5.1% to 3.6% in June. This is within our earlier expectation. The lower inflation was due mainly to the decline in domestic fuel prices. Going forward, headline inflation is expected to moderate further, assuming that the lower global prices in the second half of 2017. The external sector continued to record robust growth, supported by favorable global demand. Malaysia's gross export recorded strong growth of 20.6% in the second quarter of 2017. There was a broad-based increase across major markets, particularly China, the EU and Japan. The ongoing recovery in global manufacturing activity has lifted E&E exports, particularly for semiconductors used in smartphone and storage devices. Growth of gross import was also robust at 19.1%, driven by imports of intermediate goods, in line with the strong manufacturing export performance. As export growth outpaced import, the trade balance increased to 24.1 billion ringgit. I want to make a comment on the impact of our ringgit depreciation. In recent years, there has been question on whether our export volume has benefited from the ringgit depreciation. I think some of you have asked this question before. So what we did was that a survey that we conducted early part of this year, we found that the exchange rate depreciation had limited impact on export volume. Over 70% of companies reported their export orders remain unchanged. This is due to the high import content in export, particularly in the E&E sector. Our survey findings are in line with our earlier study, which found that global demand remained the key driver of export volume growth. The exchange rate plays a smaller role in contrast to global demand and product prices. This underscores the policy stance that while a stable exchange rate will facilitate trade and investment activity, ultimately, prospect for sustained external performance will be driven by product quality and better access in foreign markets. Our message is this: producers that rely on exchange rate for competitiveness is an unsafe business strategy. So we cannot rely on weak exchange ringgit for our competitiveness. There's a box article that details some of our findings. It's entitled Global Value Chain and the Drivers of Export in Malaysia. So it's in the Q2 report. Let's look at the current account. Current account surplus widened to 9.8 billion or 3% of GNI. The surplus was supported by a larger goods surplus and smaller deficit in the services and primary income accounts. With better than expected performance in the first half of the year, we expect the current account to register a healthy surplus for 2017. The ringgit, the sentiment continued to improve in the second quarter of 2017, supported mainly by positive domestic development. Malaysia's macroeconomic condition, which include the strong GDP and export performance, has improved investors' confidence on the ringgit. The positive ringgit sentiment was also supported by the liberalization of bond market and foreign exchange hedging requirement announced by the Financial Market Committee. The ringgit appreciated by 3.1% in the second quarter of 2017 amid non-resident inflows into Malaysia's financial market and was the best performing currency in the region during the quarter. It is also important to note that following the appreciation in the first half of 2017, the ringgit has retraced the depreciation in 2016. So somewhat we have recovered, partly. The ringgit will continue to be affected by external uncertainties. These include the timing and pace of monetary policy normalization by major central bank, the Federal Reserve policy on unwinding of their balance sheet, and the global geopolitical and financial market development. There's another important point that we wish to highlight this time round. The fact that the ringgit has decoupled with global crude prices. In fact, since May 2016, the ringgit has been negatively correlated with Brent crude oil prices. This reflects two developments. Global investors and financial market are beginning to recognize and appreciate Malaysia's increasingly lower dependence on oil revenues. Just to give you a perspective in terms of the numbers. In 2009, 41.3% of all revenues form the total of government income. In 2016, the number was 14.6%. Other key events such as the US presidential election and the implementation of 2 rounds of financial market committee measures to further liberalize the onshore financial market have outweighed the impact of Brent crude oil prices movement. So it's a very important point that we like to make is that the ringgit and the oil prices seem to be decoupled over the last few months. Let me touch a bit on the measures done by the Financial Market Committee. It has yielding some positive results. Volatility of the ringgit against the dollar has reduced significantly. The negative impact of the NDF market is also reduced as evidenced by the narrowing of onshore-offshore gap from 317 points to 162 points. The net conversion from trade has also risen. Net external conversion from trade was higher at $2.2 billion in the second quarter. That number was $1 billion in first quarter of 2017. If you look at the Malaysia's credit default swap, the spread has further narrowed, reflecting improved investors' confidence. There's also another report in the Q2 bulletin. It's on factors affecting foreign investors' bond holding in Malaysia. So this topic has been quite an interesting topic that has captured the imagination of the market. So we have put a lot of details in that report. Malaysia, as you know, has a sizable level of foreign bond holding of around 169.9 billion ringgit, or about 26% of the total outstanding government bond. Because of our good prospect, a deep financial market and investors-friendly environment, we are able to attract foreign participation. As a percentage of major bond indices, our weight has been one of the largest among our peers. Short-term investors, primarily foreign banks and some type of funds, are particularly sensitive to market sentiment and tend to adjust their portfolio frequently. So this type of investors normally will come in and go in a short duration. But then there are also longer-term and more stable investors which tend to rebalance their portfolio following changes in bond indexes. So these are long-term investors. If you look at the box article, the importance of not only the percentage of holding of foreign investors, but we need to understand the behavior of the long-term and short-term investors in our bond market. Another issue that has captured the press imagination is our position of our external debt. It remained manageable. This observation is based on the nature and profile of our external debt. About one-third of external debt is denominated in ringgit and accounted by non-resident buying ringgit instrument. Foreign currency denominated debt remain low at 45% of GDP. Of the three, the interbank borrowing and non-resident deposit are subjected to prudent liquidity management practices, which include, among others, limit on funding and currency mismatches. Intercompany loans are normally subjected to flexible and concessionary terms, such as no fixed repayment schedule or low interest rate terms. Trade credit are usually backed by export earnings. In general, the foreign currency denominated debt is largely hedged and backed by external asset. So if we look at the chart, the bond and notes, intercompany transaction and interbank borrowing form more than 75%. It's about 75% of the external debt. So if you can look at the pie chart, so it's quite manageable. Another issue that has been raised from time to time is the level of international reserve. In the past decade, Malaysia has accumulated a sizable amount of international reserve, peaking at $141 billion as at May 2013. During that period, the IMF expressed their views that this was too high. In the recent period, international reserves were deployed to smoothen excessive volatility in the exchange rate. As at 31st of July 2017, reserves stood at $99.4 billion. In July 2017 external sector report, the IMF acknowledged Malaysia's international reserve as adequate, given the flexible ringgit exchange rate and the availability of external assets for borrowers to meet their external obligation. Another point that is worth noting is that our international reserve of Bank Negara Malaysia is not the only means to meet external obligation. Banks and corporations hold 3/4 of Malaysia's external asset. That number as at end of second quarter was 1.3 trillion ringgit, which can also be drawn upon to meet their external debt obligation. On monetary policy, the OPR was maintained at 3% at the May and July meetings. As you know, growth is expected to be higher in 2017, driven by strong private sector expenditure amid more evidence spillover to growth from the robust external sector performance. As usual, the MPC will assess incoming data to determine the sustainability of this growth momentum and will monitor for any incipient sign of demand pull inflationary pressures. Let's look at the intermediation role by our banking sector. Growth in net financing increased by 7% in second quarter of 2017. This was driven mainly by an increase in the growth of net outstanding corporate bonds issuance during the quarter. However, the growth of loans extended by the banking system and developmental financial institutions moderate slightly to 5.6% during the second quarter amid some moderation in business and household loans. On domestic financial stability, it was preserved in the second quarter of 2017. Financial institutions are well capitalized to meet any unexpected shock, with excess capital buffers exceeding 170 billion ringgit. Our banking institutions have sound asset quality. The banking system continues to have sufficient liquidity to support financing needs of the Malaysian economy. I think this is another topic that has been discussed in the media. Our high-level liquidity was reflected in the banking system's strong liquidity coverage ratio, which is 140.8%, and loans-to-fund ratio of 83.3% at the end of quarter. All banks maintain liquidity coverage ratio above 100%, well above the 80% minimum requirement. The loan-to-fund ratio, which include issuances of debt security in the denominator, takes into account the wider funding base of banks and give a more comprehensive and suitable assessment of banks' funding structure. So some analysts and some media still looking at the loan deposit ratio. Loan deposit ratio is no more relevant. Our banking system have deepened and expanded, and they have actually diversified the source of funding. And even at the international level, we don't look at loan to deposit ratio anymore. So loan to deposit ratio just look at the liquidity coverage ratio. That is the ratio that is being used by international bodies. Let's look at the household debt. Household debt grew at a stable rate of 5.1% and remained elevated. This number we still consider as elevated at 85.6% of GDP. Household financial assets were sustained at a comfortable level of 2.1% of household debt. Quality of household debt remained sound, with the delinquent and impaired loan ratios continued to be low at 1.5% and 1.7% respectively. But there are a few things that we need to look at, which is quite important when we look at the household debt. First, many new borrowers have debt service ratio of below 40%. So that is a good news. Second, the share of borrowing of those in the vulnerable income segment continues to come down. It now stands at 21.9% compared to a high of about 28% in 2013. Third, the bank stress test results affirm that the banks have strong capital buffers to withstand potential shock under severe assumption of loan defaulters. The reason why the household debt has declined over the last few months is that the responsible financing framework have come into effect. Total business borrowing in the quarter was driven also by new corporate bond sukuk issuance, mainly for the real estate, infrastructure and power sectors. Businesses, including SMEs, have continued access to financing. The approval rate for SME financing application from financial institutions stood at 76.4% during January to June 2017. So the intimidation by the banking sector have run quite smoothly. Market volatility remained low amid improved domestic sentiment and lower global volatility. The average volatility of the 10-year MGS yields, equity market and the ringgit have declined. Moving forward, domestic financial markets are expected to remain orderly, with investors' sentiment to be primarily affected by external development. Given the robust growth performance of 5.7% in the first half of 2017, it is likely that the Malaysian economy will grow beyond what we had earlier forecasted. This is higher than the upper range of the earlier forecast that we have given, which is 4.3 to 4.8%. Growth prospect will remain anchored by domestic demand, with some lift from export growth. Underpinning factors including steady wage growth and employment, ongoing implementation of infrastructure projects, and continued external demand for Malaysia's export. For your information, the Minister of Finance will announce the revised growth range during the tabling of the 2018 budget in October 2017. That's about 17 days from now. This time round, we want to share with you some of the policy initiatives that we have embarked over the last few months. Over the years, Bank Negara Malaysia has introduced various policy framework and regulatory advancement to strengthen monetary and financial sector stability in the country. We wish to provide brief insight into some of these policy initiatives. First, the implementation of the reference rate framework. Second, the motor and fire de-tariffication. Third, professionalizing the banking sector. And fourth, the latest progress update of our migration on e-payment. We will also touch a bit on the high medical costs that was raised a few days ago. The feature articles in this quarter release will provide a detailed account of the two initiatives that we mentioned just now. the reference rate framework, and the motor and fire de-tariffication. The reference rate framework, if you can recall, we introduced in January 2015. We replaced the base lending rate with base rate. The reference rate framework is now the reference rate to price retail floating rate loans. When we introduce them, we have three outcomes in mind. First, consumer will benefit from more efficient pricing and greater transparency. Second, it will also reflect funding strategies for financial service providers. And third, it will enhance transmission of monetary policy. As guided by this intended outcome, in August 2016, changes were made to enhance the framework. This include a requirement for financial service providers to disclose the benchmark cost of funds used to compute their base rate. The computation of base rate is also based on marginal cost of fund of the financial service providers. They are also required to revise their respective base rate within 7 working days of the OPR change. So far, we can conclude the framework has worked quite well, quite efficiently. Consumers are able to shop around for the best prices, and the base rate that is reflected by banking institution actually reflected their cost of fund strategies. Let me touch a bit on the de-tariffication of the insurance premium. Under the motor tariff pricing for motor insurance, premium were determined by limited rating factors such as sum insured, cubic capacity of the vehicle engine, age of the driver, and age of the vehicle. However, with the liberalization of the motor tariff, additional factors that reward good risk management practices and behavior will be taken into account in deciding the price of motor premium. These factors include the following: vehicle make and model and the security features, driving experience and behavior of the drivers, duration the vehicle is on the road, location where vehicles is parked, and record of traffic offences. Based on the data available from insurers as at 31st of July 2017, we observe that both premium increases and decreases are within plus and minus 10%, except for high theft-prone vehicles, which may experience higher premium increases in line with the high risk exposure. Premium are higher for younger drivers due to lesser years of driving experience, and premium are more likely to be lower for newer cars. Let's look at some of the details, and this I hope that the media will highlight. Under the motor tariff, significant cross-subsidies exist between risk segments, resulting in some policyholders paying more premium than they should to subsidize high claim incurred by riskier drivers and vehicles. So if you are paying comprehensive premium insurance, and most of you in this room are doing that, you are actually subsidizing the bad drivers, as you can see from the chart. The disproportionately higher incidences of theft observed for specific vehicle models and high claims payout for certain commercial vehicles have led to increased pressure on overall premiums. This development illustrates the problem associated with a tariff system in which weak incentive exists for vehicle owners, manufacturers, and drivers to change their behavior. With liberalization, insurers will now take into account features that will improve road safety and vehicle security, hence reducing the extent of cross-subsidization. Consumers with good risk profile should expect better pricing for their insurance premium. Let me show you the second chart on slide 32. Let's take the example of express bus, 189%. So what it's saying is that for every ringgit that express bus pay premium, the insurance industry pay 1 ringgit and 89 cents. That does not include commission and management expenses. So if we include that, we have to add another 30%. So for express bus, so for every ringgit, we have then the payout ratio is 2 ringgit and 19 cents. So that's where most of us in this room are actually subsidizing express bus drivers and owners, so which is not quite fair. That's the reason why we thought that we need to de-tariff the insurance premium, that so that good drivers like all of you will pay less insurance premium. In the banking sector, various proactive effort has been undertaken towards greater professionalism of its workforce. Further to this effort, two new initiatives will be undertaken. First, all reporting submissions made by the bank to Bank Negara Malaysia are to be undersigned by a chartered banker. This will take effect from January 2021 onwards, with the aim to promote the highest standards of professionalism in the banking sector, ensure trust and confidence in the submission of documents, and strengthen the reputation of the profession, supported by high levels of professional values and competence. Second, key personnel in critical job function will be required to acquire the appropriate specialized qualification in the areas of credit, compliance, risk management, audit, and anti-money laundering and CFT. This qualification will be rolled out in 2018, and the bank expects that the industry will strive towards 100% take-up rate within 5 years of implementation. This initiative signifies a strong commitment from the industry to continue developing an adequate pool of high-quality workforce in the banking sector. As you can, if you can recall, starting from 1st July 2017, when we use our credit card, we have to use our PIN number. The migration to e-payment continues to make very good progress. We have seen a promising trend in the decline of merchant fees, as well as an increase in the use of fund transfer and in the growth of point-of-sale terminal deployment. The industry is expected to invest about 1.1 billion ringgit over a period of 6 years, from 2016 to 2020, in order to enhance the payment infrastructure. This includes the recently completed migration to PIN verification for card payment and the adoption of contactless card. The industry is also currently working towards migrating all domestic debit cards to internationally recognized Europay Mastercard Visa standard by the end of December 2017. Going forward, PayNet, the newly merged entity formed after the merger of MyClear and MAPS, will invest about 70 million ringgit to establish the new retail payment platform. The retail payment platform will facilitate interoperable mobile payment between banks and eligible non-banks as part of our overall strategy to foster collaboration at the infrastructure level while adopting open and fair access at the product level. This will ultimately benefit consumers through greater competition and more innovative payment solutions. There are a few special issues that we would like to raise as well at this press conference. First, the publication of key employment statistics for financial sector in the bank's monthly statistical bulletin beginning end of August 2017. Second, insight into the trend of medical costs. And third, the launch of Housing Watch website today. The first one is on the job numbers for the financial services sector. In the second quarter of 2017, job creation in both the banking and insurance sectors, including Takaful, remained strong, anchored by increased demand for specialized skill set to support evolving strategies, growth, digitalization plan, and ongoing regulatory reform. 1,745 new jobs were created, of which 95% were high-skilled positions. High-skilled workers represented 74% of the workforce in the banking sector and 83% of the workforce in the insurance Takaful sector. In contrast, layoff and discharges remain low at 421 positions during the quarter. Meeting demand for talent continues to be a challenge, with 5,892 jobs vacancies reported in the banking and insurance takaful sector this quarter. In particular, strong demand for high-skilled workers continues to persist in the areas of compliance, audit, risk management, data analytics, and IT programming. To meet this, effort has been intensified to upskill and professionalize the workforce. This is expected to reinforce the capacity for future innovation, productivity, gains, and support for new growth areas. So from now onwards, we will give you the financial services sector employment and layoff numbers so that we know how much job have been created, how much layoff for the year, and we know the net job creation for the financial services industry. Let me touch a bit on the medical cost. It is on the rise, as you know. High inflation in healthcare costs, which averaged 12% per annum between 2010 and 2014, has been putting pressure on premium rates of medical insurance. So it's very important to understand is that the high cost of medical is not because of the premium. The premium increases because of high medical costs. So it's the other way around. Important differentiation need to be made. The increasing medical claim has been driven by demand for better healthcare services, an aging population and a higher prevalence of diseases, technological advancement in healthcare, and an increase in the cost of drugs and treatment. In order to manage the rising medical costs, there must be greater transparency in the pricing of healthcare products and services. An initiative that we should explore include publication of recommended retail price of pharmaceutical products, medical devices and medicine, and publication of fees for cost of treatment at hospitals to enable consumers to make informed decisions on choosing their healthcare providers. While doctors' fees are regulated, other components of private hospital charges are not. We need a framework of private hospital charges so that prices remain fair and appropriate. Consumers are advised to request for more detailed billing of charges and breakdown of cost of treatment and medicine provided to them. So consumers have to play a role in it. This is the last slide. I'd like to announce the launch of Housing Watch website. As you know, affordable housing and issues related to housing have been taken center stage for the last few months. We thought a website that contains all the data will provide timely information on the development of the housing market and home financing by the banking sector. This will also encourage more informed assessment on housing affordability. The website will also include consumer aids to help potential house buyers plan for house purchases, including information on home financing assistance program offered by the government and financial institutions. Given that housing affordability remains a pressing issue in Malaysia and has attracted wide attention, we hope that the Housing Watch website will serve as a useful platform for public engagement and information to address this issue. So we hope that consumers will use this Housing Watch website to look at some of the issues concerning financing of affordable houses. I have come to the end of presentation.